We got Nate Peterson back with us and Collin Martin. All right, the chart work here, Nate, just keeps getting more interesting by the day. We were talking about this bounce in stocks and whether or not it turns into a real reversal. Do we have to start calling it something like that here as S&Ps are almost at 4,400 and the NASDAQ's back above 14,700 handily?
Yeah, it's encouraging on the S&P to see it above its 50 SMA. It looks like it's above that downward sloping resistance line. We're approaching an area where we encountered resistance back in October. So technicals, they don't really care what happens in terms of what's moving the price or why it happened. They're just looking at price, and it is encouraging. It is a nice move for the bulls. The move is a little bit vertical, 6% this week. And, what happened? Well, it was a setup coming into the week, a lot of anxiety around the quarterly refunding program. Yes, today's jobs report was good, but it was also short covering that came in and did that as well. Look at the names like C3AI, Lemonade, Upstart, all those guys popped this week. And I don't have the data to back it up, but I suggest there was some short covering going on within treasuries as well. But what really changed this week? I think if you take a step back, the Fed's done. Well, the probabilities were already suggesting the Fed was done anyway.
Yeah.
We do have this one data point where the jobs, it looks like there's some slack there. Unemployment rate up to 3.9. That's great, but it's one data point. And what about the strikes? Is it going to come back next month? And then in terms of the Treasury refunding, yeah, it wasn't as bad as expected, but we still have this massive deficit, and there's going to be more to come down the line. So let's just take a step back. Is it worth 6% this week? I don't think so, but the market does, and I think a lot of that has to do with short covering.
Fair enough. What do you think, Collin, as far as the bond movement goes? Data, short covering, Powell, now that we've had another big move here today, how do we update the thesis?
Well, it's probably all the above, Oliver. It's been a really busy week. As Nate mentioned and suggested, we already thought the Fed was done. Powell kind of hinted at that. If we go back to Wednesday, he tried to talk hawkish and talk about the door being open, but he was highlighting that inflation is coming down. And if we fast forward to today, it was a really good jobs report for the Federal Reserve. One thing the Fed's been waiting for has been that loosening of the labor market. It's been admittedly tight for the last, not just number of months, really since the whole recovery since the pandemic hit. And if you look at today's numbers, it was pretty good. We saw slowing in payroll gains, which is nice. We're not seeing losses just yet, although we did see that on the household survey side. But we saw a slowdown in the gains, a revision from the previous month. And then I think most importantly, we saw average hourly earnings continue to tick lower, and on a month-over-month basis, it came in at 0.2%, a little bit below expectation. So we can't say the door is shut for additional rate hikes, but we certainly think it's very much closed. Or almost closed, rather. We think it's very unlikely that they hike from here. If we look at the big move, though, we can see yields move up a little bit from here. One report doesn't necessarily make a trend. It's a step in the right direction. We think, the trend will ultimately be lower in yields from here, but it'll probably be a bumpy road. And we already started to see that as the day progressed, where we've seen 10-year Treasury yields inch up a little bit from the lows they hit earlier.
This is where my mind starts to get a little warped here, because everything you're saying is totally logical. But then the market takes it one step further, as you know, Collin, which is not to just price in no more hikes, but then to start aggressively pricing cuts. We're 525 to 550, the current target rate from the Fed. All we got to do is go out to June to see where this market gets really extreme. And right now, the odds of a double cut by June are now almost 40%. I mean, that's like borderline madness, it seems like. Where does that come from when the data is as strong as it is? How is there any logic behind that jump, which is no more hikes, to doing two cuts?
It does seem like a big jump, Oliver. The economy is admittedly strong right now. That's why we saw the recent rise in yields, although it's basically undone. But the economy is on relatively solid footing. Now, am I surprised that we're seeing those rate cuts priced in?
And sorry,
if you asked me
cut.
6 months ago,
two cuts is only 10%.
10%.
Yeah, I misspoke.
If you asked me 6 months ago, I probably wouldn't be surprised, because when the Fed hikes, there are consequences. It slows down the economy, slows demand, it brings down inflation. The economy has been much more resilient than we expected. We saw that, but we are actually starting to see those cracks now. I think it is probably early to start talking about those cuts. A lot can happen between now and next June or July, but it is possible if this trend continues. The cuts might not necessarily be to significantly stimulate the economy. It just could be a step back so that policy isn't super restrictive anymore. Because if they hold rates steady for a while, let's say the next 6 months, but inflation continues to trend lower, that actually makes things tighter and tighter on a real basis. So it could just then be the Fed recalibrating a little bit, taking the foot off the brakes a little bit, but not necessarily in a strict easing mode, cutting rates to what we've seen over the past few rate cut cycles.
All right. Good conversation. We got to leave it there. Great stuff. Thanks for the thoughts on bonds, Collin. Thanks for your help all week, Nate. Been a rock here for us. Been a pleasure with the chart analysis and the stock analysis.